Welcome to part one of Introduction to Financial Statements. If you're taking an accounting class right now, you've probably heard of the balance sheet, the income statement, the statement of retained earnings, and the statement of cash flow. You might be wondering, what are these statements? How do they work together? What does this have to do with accounting? Where does a journal entry come in? And we'll get to that. But for these next two videos, we're going to focus on the balance sheet and income statement. They're the two main financial statements, balance sheet and income statement. All your journal entries that you do in accounting will affect these two statements. We'll also slightly touch on the statement of retained earnings, and in a future video we'll go over the statement of cash flow. So, what is the balance sheet? Well, the balance sheet is a snapshot in time of a company's assets, liabilities, and equity. And it's important to note that a balance sheet is a snapshot in time. Think of it as a photograph of what a company has. And to understand that, we got to first understand, what are assets, liabilities, and equity. So, an asset is just some sort of future benefit to your company. Anything that will help your company in the future. So think of it as simply as inventory. Inventory is something that a business will sell and generate revenue. So it will have a future benefit because that future benefit is the revenue. A liability is a future obligation, essentially the opposite of an asset. It's something your business is going to owe at some point in the future. That could be a loan that you took out with the bank, and you're going to have to pay them money back at some point. So you have a liability, you have debt. That's on your balance sheet. Equity is a little bit different. Equity is made up of either retained earnings, which is just a fancy way of saying reinvested profit, or contributed capital, which is when you sell ownership. So people give an asset to a business, usually cash, in exchange for an ownership percentage of the company. So that's what assets, liabilities, and equity are. Now, also very important to know on the balance sheet is the golden rule of assets always equal liabilities plus equity. This is usually somewhat of a difficult concept to understand. And think of it this way, and we'll get into an example in a second where hopefully it will make more sense, but think of it as assets. That you can't have an asset unless it came from a liability or equity. So it has to come from one of these two parents, liabilities and equity. One of the two has to be a parent of an asset. Can't have it without it. Okay, so next I'd like to walk through an example of a startup business. Let's say, there's the income statement. We'll introduce that in a second. Let's say we are going to start up an ice cream cone business. And on January 1st, 2015, we say, let's start up a business and we'll sell ice cream cones. So we come up with the concept of the business on 1/1/15. Nothing has happened, no transactions have happened yet, no business transactions have happened yet, so no need for accounting. So we'll walk through the effects on the balance sheet and the income statement. The income statement, just as a quick thing, is the income statement is basically what most people think of when they think of a business. It's the revenue, so the money that a business has generated, minus all the expenses, all the business expenses associated with that revenue, and equals the profit. So at the end of the day, this is basically what people want. Is you want your business to be profitable, to make money, so that you can pay yourself a big salary, and so that you can sell your business, or so that you can just keep running your business. So the income statement. Now the income statement, unlike the balance sheet, is over a period of time. So the balance sheet, you're asking for, hey, what does it look like on 1/1/15? What does it look like today on 1/31/15? The income statement, on the other hand, you say, hey, what was our income statement for the period of 1/1/15 through 1/31/15? And I'm sure it will make sense as we're going through it here. So let's say we start up an ice cream cone business on 1/1/15. And the first thing we have to do is we have to raise funds. So what are we going to, we need some cash. So you tell me that, hey, I have $30,000 cash right now in my pocket that I'd like to use on the business. And I say, great, that's awesome. And you're saying, all right, well, I have cash and you say 30K. And you're like, well, Mike, my balance sheet doesn't match, the assets don't equal my liabilities plus equity because I don't have any equity. I just had $30,000 cash. Now this is a common error here, and that $30,000 cash is going to be considered contributed capital. So you may have already been 100% owner in the business, but now you've contributed capital to that business, and that 30 looks a little funky. Let's clean that guy up a little bit. Looked like an ugly 3. There we go. So now our assets equal liabilities plus equity. Note that this raising of cash does not affect the income statement. That is not considered revenue. So next, let's say we want even more money to start a business. So we get our mom. Let's say we ask our mom to loan us, I don't know, $20,000. She says, all right, I'll give you the $20,000, but you're gonna have to pay it back to me at the end of the year. So we're gonna owe her back. We have a future obligation now. That is debt. Or a loan, we can, whatever you want to call it. What did I say, 20,000? So here's 20,000 here, and we'll just increase our cash to 50,000. Note, once again, does not touch the income statement. Next, cash isn't going to generate revenue for us, so we need to turn that cash into something that we can generate revenue with. So let's buy some inventory. So inventory, well, let's say we buy 20,000. No, we just used 20. Let's say we buy $25,000 worth of inventory. So our cash has gone down by 25. What was it, 50? Yeah. So 25,000. And a lot of times what we'll see here is inventory expense for 25,000. Unfortunately, that's not correct. So what we do here, we capitalize our inventory. What does capitalization mean? Inventory. Capitalize means you take something that could have been an expense, a cash outflow or an outflow of the business that could have hypothetically been an expense, but moved it to the balance sheet for a specific accounting reason. So it's on the balance sheet. So this is going to say 25,000 here of inventory. Well, why did we do that? Well, if you can remember from our Introduction to Accounting Principles video, the matching principle says recognize expenses in the period they help you generate revenue. So the inventory of 25,000 here needs to be capitalized because we haven't sold anything yet. So it hasn't helped us generate revenue. When it does help us generate revenue, when we do generate some revenue, we'll take that inventory associated with the revenue value and we will expense it out off the balance sheet into the income statement. So next thing we want to do is we want to buy a truck. We got to sell the ice cream out of a truck. Let's say the truck is $15,000. So the truck, a lot of times, once again, we'll go truck expense over here. Unfortunately, that's not true. Truck, once again, is capitalized. Why? Well, the truck is going to help us generate revenue for years and years to come. So we capitalize it and we partially depreciate the truck over the life that it helps us generate revenue. We'll get into depreciation in a future video. I just wanted to bring up the subject here. So let's say we also pay for the truck. Let's tell the vendor, ask the truck vendor, say, hey, can we pay for that in 6 months? Because I don't want to pay for it now. And they say, sure. So what that's called is accounts payable. It's a liability because it's a future obligation, and we owe our vendor $15,000 in 6 months. Note, once again, we have not touched the income statement yet. Only balance sheet items for the transaction so far. So what is our total assets? Is $65,000, and our liabilities plus equity are also $65,000. Great. On the next video, we'll walk through the month of February and see how certain transactions move from the balance sheet to the income statement.